discuss these questions and seek clarifications, we have with us Professor Ananth Narayan. Professor Ananth Narayan is a professor at the SPJIMR Institute, popularly called in Bombay as SPJIN Institute. So I'm sure most of you would know it's a very popular institute. He is an international banking and financial matters markets expert. He has previously worked with Standard Chartered banks. He was a regional head for financial markets for ASEAN and South Asia, managing foreign currency, interest rates, commodities, derivatives, and debt capital markets, business across 12 countries. Prior to Standard Chartered, Professor Ananth Narayan has worked in Deutsche Bank and Citibank. So he's with banks for long, also in the areas of financial markets and trading. Good afternoon, Ananth Narayan. Welcome to the show.
Good afternoon, sir, and thank you to EPS for having me.
Thank you very much. We are privileged to have you, sir. We are live on EPS Direct channel, Facebook, YouTube, and Twitter. Professor, have you heard about this EPS show, and have you watched any of our shows? Do you have any comments to offer?
I think you're doing a fantastic job, sir. As you said, in times like this, when lots of things are happening and the syllabus is changing online, so to speak, in our lives,
yes.
I think you're doing yeoman service in bringing the opinion of a lot of good people to everybody and to share their views, etc. Please continue the good work, and I hope and pray this lockdown ends fast so that we can go back to normalcy and some semblance of normalcy at the very earliest.
Excellent, sir. Thank you. So we begin our discussions, our dialogue as we call it, and there will be questions that will come from the participants, which will come in the Q&A box. There could be a couple of questions directly from the participants directly to you. So we will facilitate that and get you across.
Sure.
So in a recent webinar, in fact, it was a recent webinar, and I think it was from SPJIMR Institute only, Mr. Subbarao said growth of 5 to 6% approximately in 2019-20, and a contraction of 5% in 2021 would mean that the economy will actually dip by as much as 10%. That kind of a depression is very difficult to handle, even for a rich country. Similarly, Howard calls it the India's great slowdown. That's what they named it to one of their articles. So to give a perspective to our discussion, what is happening with the Indian economy? Are we in big trouble?
Well, the whole world economy is in big trouble, sir. There's no doubt about it. Clearly, COVID-19 is a once-in-a-century kind of an event. The last time we saw something comparable was, as you know, 100 years ago exactly, in 1918. So absolutely, the fact that every major economy is going to see a large contraction, and therefore the global economy itself is going to contract in a big way, is clearly a huge body blow to the global economy. In fact, the IMF has just come out and said that they're going to revise their already pessimistic numbers of minus 3%, and they're going to bring it down even further. Now, specifically for India, sir, the problem is even more accentuated for a couple of reasons. One is we are a poor country, right? Our per capita income is $2,000. We still have a lot of aspirational, population looking to grow quite fast. And for us, our capacity to bear a blow of this kind is obviously limited. Rich countries which are earning $50,000, $60,000 of per capita income clearly have a lot more of space to combat an event of this kind. The second problem for us, of course, is that we already started our economy on the weak note before COVID-19 hit us. Unfortunately, the health of our overall economy, whether it's the health of the financial ecosystem, whether it is sectors such as power, real estate, etc., or just employment in the state of employment in our country. And this is not just a matter of last few years. It's been there for many, many years where we've been struggling with these things. So a combination of the fact that we were already weak coming into COVID-19, we are a poor country in many ways, a long way to go in terms of economic growth. And this is a once in a multi-generational kind of an event, which is going to deliver a body blow to us, will leave us in a bad shape, no questions asked. It might well be, sir, that this is the worst that we've seen in our living memory. I don't want to overemphasize this. This could be the worst we've ever seen in our lifetimes.
Thank you. Yeah, so that's the, so I think we still have a lot of hope. So we will look at that. So if you look at the, things that have happened, I think three notable things have happened. Maybe there are some more, but to my mind, the ILF's failure, the mounting NPAs, okay, and now COVID, with almost Bernstein expecting a negative 7% growth, Goldman and Sachs seeing a 5% contraction in the Indian economy. What steps can the government take to insulate the economy from such calamities? Is there a way to do something?
I'll take this in a few parts, sir. To start with,
Yes.
What you mentioned about ILFS, etc. Let's even go one step behind and try and put this in a broader perspective.
Sure, sir.
Clearly, there were some problems in the economy coming into COVID-19. By the way, I promise you, like you said, there is light at the end of the tunnel. I think we will come out of this, and India always manages to come out of this. But
Good to hear that.
It's only fair that we take a realistic look at what the situation is, so that we can diagnose and then prescribe what needs to be done. So I would put this as broadly 3 or 4 sets of issues that we were grappling with, not just over the last 3-4 years, but for multiple decades, so to speak. First is the gradual deterioration in the state of our financial sector, whether it is banks, non-bank finance companies. While things came to a head with the ILFS situation, and thereafter a few other banks and cooperative banks also kind of wobbled, but this has been building up over time. So the first problem is we've had trouble acknowledging the true state of our financial sector. The official number as of September 2019 was that between banks and non-bank finance companies, as per RBI data, the non-performing assets was about 8.6% of advances. Okay, the actual number, if you look beyond forbearances and you account for the fact that NBFCs have not gone through a proper disclosure, process, such as banks have gone through the asset quality review of the RBI. The actual number was already probably 11 to 12% of advances, which is a very, very big number, which means that the financial system was burdened with this concept of non-performing assets, which was limiting their ability to support growth in the economy. Second big problem, which again has been going on for almost a decade now, several sectors of the economy have been struggling and have had chronic stresses to grapple with. Let's take the example of real estate. It's been going through trouble for many, many years. Again, we've been kicking the can down the road, not recognizing the fact that there is something which needs to be done, at a very core level. Likewise, power sector. Every year, the distribution companies collect far less money from people like you and me than they ought to. And in fact, they have to borrow money just to pay the power producers. So several power producers themselves are not viable. On top of it, distribution companies run by state governments are also not viable. That entire sector is in one large unviable sector, which is just being the can is being kicked down the road on that as well. The third part, which I mentioned, is in terms of employment. And every time we speak of India's greatest strength, we know it's our people, right? We have a young aspirational population, fire in the belly, very capable, very smart people. We definitely are capable of big things going forward, but we've not been able to provide jobs to them. In fact, we've seen jobless growth for many decades now, right? And some of the, while clearly there's been improvement, it's not to say there's been no improvement, but some of the statistics are still very, very disappointing. If 44% of your workforce is still engaged in, agriculture, which barely accounts for 15% of your GDP, there's an underemployment problem. People are not in agriculture because they want to be there. They'd much rather find something else, except there isn't something else to find. Likewise, the worker participation rate is barely 35%. If you have a young population, which is aspirational, you need to have a lot more number of people who are actually working. Similarly, only 17% of our GDP, as measured by the CSO, is contributed by women, which means, we are just not using our women folk enough. Countries like Vietnam and Bangladesh, which have done remarkably well in areas like ready-made garments, they've used the women workforce very, very well in order to become a lot more productive. So there are several such issues in terms of, and I don't even want to go into things like the periodic labor force survey, which shows very, very high unemployment, particularly amongst youth. Rural youth, it's almost like 18 to 20% of unemployment. So there are several such issues in terms of jobs as well, which goes back to the fact that we have struggled to make India a easy place to invest and create jobs in for many, many decades now. why is it that we still have a $50 billion trade deficit with China, where we're importing practically everything, electronics, plastics, fertilizers, chemicals, a whole set of input factors all come from China and from other countries. So the fact that we have a cheap labor force, our per capita income is 1/5 of China, and yet their products tend to be cheaper than ours. It just doesn't make sense. So clearly, we've not been able to create jobs either. Now, over the last few years, unfortunately, because we've seen a slowdown in growth, we've seen, the last year, FY20 growth was barely 4.2%, very, very low. The government has been trying hard to actually prop up the growth, and therefore the fiscal deficit is far higher than what the official numbers suggest. So already for the past few years, we've been printing and spending as the government tries to spend money, and the RBI has been supporting that with government bond purchases, etc. So broadly, I guess the weaknesses coming into COVID-19, where a weak financial ecosystem, several sectors of the economy, power, real estate, telecom, airline shipping, which are chronically stressed, employment not being created, us struggling with investments and creation of jobs and output, and therefore already the government having to print and spend to try and prop up the economy. That was the state into which we entered. Now, COVID-19 is going to be a body blow in many, many ways, right? So if you've had a lockdown which is more severe than most other countries in the world, we've shut down big chunks of our economy for more than 2 months now. And unfortunately, the nightmare isn't over as yet. Chennai has just announced that they will have one more lockdown towards the end of this month again, which is, it's going to be a prolonged misery for our economy. So multiple things will happen through this crisis. Clearly, there will be a degrowth. You mentioned numbers from Goldman Sachs, from what Dr. Subbarao mentioned. Dr. Pranab Sen has gone so far as to say we could actually see a double-digit contraction. And he's the former Chief Statistician of India. He knows what these numbers look like. So it's quite possible we see a very, very sharp contraction this year. Our workforce and our businesses are going to take body blows as well. Workforce, 83% of our workforce is either self-employed or casual, daily wage workers. Only 17%, as of, again, Labor Bureau statistics, are actually salaried workforce as of 2015. Now, that tells you that the pain amongst the workforce is going to be dramatic. It's going to be very, very large. Similarly, businesses, we have 62 million small and medium, small, medium enterprises. At least anecdotal reports and some research reports suggest that many of them might simply not survive this long period of closure. And there are many sectors which have chronically been hit by this process. NPAs will go up. I said 11 to 12% already is bad enough. That might go up to 18 to 20% for banks and NBFCs put together. Likewise, the fiscal deficit of the center plus state will have to go up. We don't have a choice. We have to spend our way out of what looks like a complete humanitarian and economic disaster. So to answer your question, it's a very long preamble, but to answer your question on what can we do from here, I think the first part is to recognize what the true state of our economy is, and then to realize that this calls for deep surgery now. It's no longer enough for us to play around the fringes and take an aspirin or two and say things will move on. It won't move on. We need a lot of good policy to be taken. The good news is all the ingredients are there, and a lot of smart people have already said what needs to be done. But here is what I would do. First is, I think in the immediate, for the immediate now and here and now, clearly we need relief measures. It's very difficult to spur an economy which is under semi-lockdown even now. You cannot expect demand to suddenly come up because we simply aren't going out and spending money right now. So even if you give money, it'll be saved. So you have to give money, but give it to the people who require it. So as I mentioned, if a big chunk of the workforce is, the migrant laborers who have gone back to the villages, if they're struggling to make ends meet, make sure that they have money, which is happening, by the way. So the increase in MG Narega, I think is a good sign. We probably need a lot more of that. Make sure money is given to the people who need it for essential services, for food, for medicines, for rent, and so on and so forth. So the bottom of the pyramid has to be taken care of. That's the big chunk. Second thing is, the medical response itself. Make sure that, for instance, if people need treatment, if you need to create more temporary hospitals, if you need to create infrastructure for the medical quarantining and so on and so forth, make sure all of that is taken care of. So the money which has to be spent right now is both for humanitarian relief to the bottom of the pyramid, as well as to immediately combat this COVID-19 crisis itself in terms of the medical crisis. So that's the first part. Now, this unfortunately will mean our fiscal deficit will get stretched even further. Now, I'm supposed to be a fiscal hawk, but I'm saying we don't have a choice. If you're in a war-like situation, you have no choice but to ensure that you use your granaries, you use your food, reserves that you have, and make sure nobody actually starves. So that's the first part. Thereafter, as and when this COVID-19 is behind us, and hopefully that happens really fast, I do hope they find a vaccine or a cure really quickly. Even otherwise, as we start to open up and come back to some levels of normalcy, we've got to do a lot of cleansing. Okay, the financial sector is in a mess, and the quicker we acknowledge this is a mess, and the quicker we acknowledge that something deep has to happen out there, I think that's a big chunk. Second, those sectors which I talked about, which are chronically stressed, whether it's real estate and power, these are dragging us down. So the more we kick the can down the road and pretend these don't exist, the more we're making it difficult for us to create jobs. So both cleansing of the financial sector and of these chronically stressed sectors like power, real estate, telecom, airline and shipping has to happen right now. Thereafter, what the Prime Minister mentioned, he talked about the big reforms, labor, land, laws, getting in supply chains from China. Essentially, it has to be about creating jobs and output. If there is one solution to all our problems going, let's say 1 year, 2 years, 3 years down the road, it is about creating jobs and output. So just as in 1991, we had the first generation reforms, which gave us access to global markets, which de-licensed our manufacturing, our imports, exports, and so on and so forth. We now need the second generation reforms, which will make it easier for us to create jobs and create output. If there is one mantra which we have to push on, it's this: how do we create jobs and output? And I think the ingredients are there. We know we have a good workforce. We know that people want to move supply chains out of China. We know we are a consuming society ourselves. We need electronics, we need fertilizers, we need plastics, we need chemicals, we need a whole host of consumer durables. We have to start making all of this for ourselves, if not for the rest of the world. So creation of jobs and output has to be a big part, which will not happen right now, unfortunately, but the plans have to start right away. So to answer your question, sir, immediate, take all the emergency steps required to stave off this humanitarian and medical crisis. We don't have a choice. We have to spend money for that. Alongside that, for the medium term, we have to first take this baggage out of our back, which is cleaning the financial ecosystem, cleaning the chronically stressed sectors like power and real estate. Alongside that, the third, the final, panacea, the final thing which will give us nirvana is jobs and output. We have to create jobs and output going forward, and the opportunities are there. I think we can do it.
Thank you, sir. That is really a good insight into where we are, what we need to do to kind of move on. And I think some very realistic things, Professor, you have said about the financial sector and the real estate and the power sector. Clearly they are in great distress. But the government and RBI announced several fiscal measures to address liquidity problem and to give enough liquidity to reboot the economic activities. Is it having the required impact?
Only partly, sir, in my view. Okay. So first off, it's easy for me as a professor to sit on a chair and say the government is not doing its job because, after all, I don't have to face the decisions that they have to face. So I have to admit to that. But even as an armchair critic, here is my little take on this. As I mentioned, what needs to be taken care of right away, right now, is the humanitarian crisis and the medical crisis. Both are tough. I mean, medical crisis, it's easy for me to say solve the medical crisis. If you have several generations worth of lack of investments into medical infrastructure, you cannot create suddenly ICU capacity or ventilators overnight. It does take time. So it's not easy to do that. Nevertheless, here is what I think is required. At one point of time, CMI was saying that the unemployment has gone up to 23%. Now it's come down again to 13 or so percent. So it's coming down, thankfully. But even then, we know that on the ground, there are lots of people who have not had a livelihood since the last couple of months. Right? Lots of households are actually reporting that they're consuming less food now. Now, good things have happened. Let's be fair. So the PDS system, particularly in the rural areas, is working. So people are getting that 5 kgs of rice every month, which has been promised on the PDS. So that's happening. But Nevertheless, there are plenty of households where there is genuine distress, where we need money to be given out. Now, the enhancement of NREGA, almost doubling of the amount given to NREGA, is a good sign, but I think that there needs to be a lot more. So to start with, I would push for more money in the hands of the bottom of the pyramid. Something like 3,000 rupees per household on a monthly basis, maybe for a couple of months, may well be required. This is both for staving off that humanitarian disaster of people not consuming enough simply because there's no jobs and livelihood. Second, if you give it to the bottom of the pyramid, the chances that some economic activity ensues will be higher. If it comes to people like you and me, we will not spend. We will just keep it in the bank account and do nothing right now because we can't spend. So give it to the people who will spend. So I think that's the first part which ought to be done, where NREGA improvement is good. Giving money to widows, giving money to Divyangs is good, but it's not enough. I think a lot more needs to be given out there. Okay. In terms of RBI's action, I think they're doing a lot, to be honest. And to be fair, they've cut down rates very sharply. The headline repo rate is now at 4%. The actual operative repo rate in the market is even below 3%. The TREPS rate, as it's called, or the market repo rate, is below 3%. So they've actually brought down rates quite sharply. Even the 10-year bond yield, despite the fact that the government has announced extra borrowing, 4.2 lakh crores of extra borrowing at the center, 2% of GDP extra borrowing at the state, despite that, the 10-year bond has come below 6%, and it's staying well below 6%. So clearly the RBI is doing its job in terms of bringing down rates. One thing which is falling between tables, though, between the RBI and the government, is the state of the financial sector. Now, giving tons of money to banks and NBFCs and asking them to lend will not get them to start lending. As I mentioned to you, banks are in no state to lend because they're grappling with NPAs, both present as well as future NPAs, which are going to come about. So there is a trust deficit, there is a fear factor, which is preventing lending. Giving money is not the answer. Then that's not going to start the whole process. So somebody has to step in and start assuming credit risk. To be fair, the government has said we will do 3 lakh crores of lending guarantee to SMEs, etc. But that's not enough. It's the other problem with lending money of this nature is, if you're an MSME which is running a business and you're struggling with fixed costs at a time when their top line has gone to zero, let's say you're an auto parts manufacturer, top line is zero, you're still paying rent, you're still paying your factory workers some wages or the other. That's a huge blow to your bottom line. Offering more money in the form of loans, is hardly the solution to the problem. You're only increasing your debt when your real problem is the bottom line. So some ways in which bottom line relief can be given has to be found alongside this money being given to the bottom of the pyramid in terms of actual people and households. All this costs money. So it's easy for me to say spend 2, 3, 4% more of GDP on the fiscal side. I think genuinely 1 or 2% more fiscal spending should be done purely to stave off a financial and a humanitarian crisis. So to answer your question, sir, some amount of work has happened, especially from RBI, but I think a lot more needs to be done, particularly putting money in the hands of people in the bottom of the pyramid, saving the bottom lines of some of the MSMEs which are really stressed at this point in time, and somebody stepping in and starting to take credit risk in a big way, because banks and financial institutions are in no position to do that right now.
Thank you, Professor. I think that was a fantastic insight into what is really required to be done, and what, according to you feel that just putting money there will not work as long as the demand doesn't pick up. And so give money to those people from where demand will come up is what Professor is talking about. And I think he was very candid that it's very easy to sit in this armchair and say things, but it's the people who actually make the decisions are on the firing line. So we should take cognizance of that statement. So, ladies and gentlemen, we are we are discussing further into this on this topic, and as usual, please send in your questions and answers. Sorry, just the questions, not the answers. That's otherwise you wouldn't ask. So give your questions in the Q&A box, and if you have a query to ask directly to Professor, please raise your hands. The back office will help you to ask the question directly to the Professor. So let's move on, sir. It is with the steps taken in the last few weeks, green shoots are now visible in the economy. Power consumption, which was earlier reducing, is increasing. Fertilizer sale in May this year has doubled since May last year. Kharif is showing at 12 to 13% compared to last time. This is what our Prime Minister said. It was good to hear this. You know, in a gloomy situation, when you hear such things, it's always great to hear. So this is what Mr. Modi said in his telecast online. So do you see somewhere that we are with the unlocking of the economy in phases? Are we beginning to look up?
Again, great question, sir. Unfortunately, data will be very, very difficult to come by. In fact, We've not had inflation data. We've not had even IIP data of reliable data come through right now for obvious reasons. But here is the thing. Absolutely, we will see reopening, and therefore we will see the economic activity reassuming, right? But here is the problem, sir, and here is where the base effect makes a difference. In the first 3 weeks, when we had, in fact, which was extended to the 4th week, from 24th of March to I think till 20th of April or so, barely 35-36% of the economy was working. When you had a complete nationwide knockdown, the only sectors which are arguably not impacted were agriculture sector, public administration, the Babus were still getting, the administration was still happening, so that was going on. Health sector was still performing. So some, barely a few sectors were performing. Bulk of the sector simply stopped, right? And there was enough confusion about logistics. There was confusion about raw materials. There was confusion about labor, and so on and so forth. Thereafter, of course, we've started opening up. So from 20th of April to 3rd of May, we saw some opening up. 3rd of May to 20th of May, we saw some another round of opening up. 20th of May to 31st of May, we saw more opening up. And now, hopefully, we've progressed since then. Of course, this Chennai thing is a bit of a setback. Hopefully, we don't see any more lockdowns, particularly in cities like Mumbai and Delhi, which are obviously having issues on the medical infrastructure perspective. But the point is, even today, if you look at Google mobility data, if you look at the actual activity on the fact that shopping malls are still closed, the fact that airlines and travel is still very, very constricted, particularly for passenger traffic, the fact that discretionary spending of any kind, people going out for entertainment, tourism purposes, etc., is just completely stopped. So even now, you could argue that barely 75 to 80% of the economy is actually operating. It's not just the fact that people aren't going out to lots of activities are still closed. The fact also is some people have not been earning for the last 2-3 months, and therefore their spending capacity has also come down. Almost every household, particularly in rural India, is reporting a reduction in consumption simply because they want to conserve cash. So given that situation, yes, we will see improvement from the fact that only 36% of the economy was operating till 20th of April to whatever, 75-80% now. But nevertheless, there's a long, long way to go, which is why the chances, I have some sympathy for what Dr. Pranab Sen says. Almost all of us, my own estimate was -5 to -6% for the growth for FY21. And my assumption was that, after the 31st May lockdown opening or 3rd June lockdown opening, maybe for a month we will still struggle, and thereafter we will be back into full throttle 100% operations. It doesn't look like that's going to happen. It might take a lot more time for things to come back to any kind of normalcy, really. And the more it extends the fact that you're not at 100%, the less the growth will be, the more the contraction will be. So I think you have to start by accepting that even if numbers look better month on month, because we were starting from close to zero, any comparisons of month on month will not make sense at all. The fact is we will still end the year sharply lower than last year. Now, by the way, this is nothing to be, it's not only us which is seeing a large contraction. Pretty much every country in the world is seeing -7, -8% contraction for the whole year. But to the earlier point we discussed, our capacity to actually manage a slowdown, given we are a poor country and grappling with issues even before COVID-19, is obviously on the lower side. So yes, there are green shoots. Hopefully we will come back to 100% activity. But the fact that we've lost this 3 months, a whole quarter of this fiscal year, in the process of coming out of this lockdown, is going to have a deep impact on our economy, our consumption, our economic activity, and our confidence in general. All we can pray for as far as the medical situation is concerned is that, like I mentioned, we don't have any more further lockdowns. Remember, in Spanish flu, we had 3 waves of Spanish flu. It went from December 2000 or 1918 all the way up to 2020. 1920, sorry. So, hopefully we don't see that. We find a vaccine fast, we find a cure fast, and therefore there's no further questions of lockdown, etc. The economic blow is big. I think we have to accept that, move on, and focus on what is it that we can do from here. Solutions for every problem of the country, solutions exist. There is no problem in the country that we cannot solve.
Thank you, sir. So there is hope. That is what Professor is saying, that we will come out and there will be hope. So, Fitch Ratings kind of had forecasted a 5% contraction, given that every country is going through. But the good part is that they have projected 9.5% growth in GDP in the next fiscal year, which is an excellent way of, it's from the gloom, we suddenly see perhaps a light in the barrel in the next fiscal year. What, according to you, should the government do to pull out and ensure that we achieve the projected 9.5% growth?
So here is the point, sir. Our total GDP for FY20 was about 200 lakh crores, 200 trillion rupees, 200 lakh crores, let's call it, okay? Now, if we contract by 5% for FY21, which is, by the way, a conservative number, numbers are much higher, we will end at 190 trillion rupees, 190 lakh crores, okay? From there, if you grow even by 10%, you will grow by another 19 lakh crores the next year, you go to 209 lakh crores. So over 2 years, your growth will still be minuscule. It will not be, and this is all nominal growth, by the way. We're not even talking about real growth. This is nominal growth. So the point is, if we see a big recovery in FY21 or rather FY22 the next year, even then it's not enough. Statistically, we will show big recovery. It's a matter of a simple matter of statistics, right? But the fact is that's not enough. The fact is we have to continue with that for a long, long time. Second thing is, look, every analyst, including yours truly, who's giving you numbers right now is talking through a hat. Who the hell knows what's going to happen over the next 3 months, 6 months, let alone the next 1 year? So much depends upon the policy steps that we take. So rather than, I think our focus has to be what can we do right now to define that narrative, rather than saying, okay, if I do nothing right now, what's going to happen next year? That's a silly kind of a discussion point altogether. It is so dependent on the steps that we take. And as I said, if we can go about creating jobs and output, which to me is the biggest requirement for this country. If we can start creating 1 million jobs, every month, which is supposedly the number that we require on an ongoing basis, and we start drawing in supply chains from China, I think we have pretty much solved all the problems of the country in the medium term. So much depends upon that I would rather focus on what we need to do than trying to project. The other thing, analysis, which I don't like is the following. A lot of people say, listen, oil prices are very low, energy prices are very low. That's a tailwind for us. So that should benefit us. Likewise, people say, you know what, people don't like China now. Anyway, US-China was having a trade war. US companies were trying to move their supply chains out of China, which is known given the trade wars. Now with this COVID-19 situation, even the rest of the world is having question marks about China. So maybe that I hate to call it anti-China, but anti-China sentiment will bring in supply chains to India. Now, these are tailwinds that we should be grateful for and move on. But we have to realize that our strategy cannot be based on serendipity and tailwinds. It cannot be based on that, yes, oil prices will remain low, therefore we'll do well. It has to be, what do you do positively to ensure that you have momentum, rather than waiting for the wind to blow your sails. So to me, therefore, the point goes back to what is our strategy for resuscitating this particular economy. This economy is going through trouble. The first part is, please acknowledge it is in trouble. And then acknowledge that you require deep surgery, you require deep amount of treatment to move it out of where it is in the hospital bed to a situation where it becomes healthy and fit to run a marathon. We need this country to run a marathon right now as an economy.
Absolutely.
So the point I made about cleaning up financial sector, about cleaning up sectors like power, real estate, telecom, etc., and creating jobs, change the land laws, change the labor laws, change the rule of the legal processes, the way in which we design policies, make it easy for people who are investing to create jobs and output in this country. We have a fantastic workforce. Make it easy for people to bring in. There is so much of goodwill, sir, for India. If I speak to global investors in my capacity as a analyst for Observatory Group, when I tell them that India is going through tough times, they look at me and say, no, you're missing the wood for the trees. Look at South Africa, look at Brazil, look at Russia, look at Turkey, look at Indonesia. You guys are in a great shape. India's in a good shape. There is a lot of goodwill for India. So we should tap that. The fact that everybody wants us to be the next China, we should tap that. If we can do some minimal, policy changes, I think we can absolutely bring in the investment dollars, as well as get our own entrepreneurs to start investing, creating jobs. Once we get into that virtuous cycle of creating jobs and output, all our problems are solved.
Right. So ladies and gentlemen, one important fact that Professor is stressing is the creation of jobs. I think that's one thing. If we do it right, everything else around it, supply will, demand will pick up. There will be a lot more money people will have, and so the entire wheels of economy will start, driving across various sectors, and that's the one big solution I think we require. Professor, you've been talking about getting the supply chain from China. 2-3 times you did mention about this. Just for the participants, could you explain what you mean by that?
Pretty much any industry in the country today, for instance, you look at consumer durables, air conditioners, refrigerators, you look at automobiles, you look at even pharma, the chemicals which go into other farm, the components which go into a pharma molecule, etc. The amount of goods that we import from China in order to make those components is extremely high, right? Likewise, yes, we are starting to manufacture or assemble at least the smartphones in India, but even now the components come from China, Taiwan, Hong Kong, from Malaysia, and so on and so forth, right? So the fact is, a big bulk of the supply chains to almost every industry, most of them which are people intensive, which are labor intensive, the supply chains don't reside with us. They reside in other parts of the world, particularly in China, right? Now, China is no longer a cheap place for labor. It's in fact, because it's become a middle income country where per capita income is $10,000. It's cheap labor is, for the last 10 years, it's not been an advantage for China at all. It's now moved into a level where it's technology, it's innovation, which new kind of, and the whole infrastructure which has been put in place, which is clearly creating that value proposition for people to invest in China. Now, we've got to duplicate that as well, because we have the people, we have the land, we have no reason why we can't replicate a healthy ecosystem for people to start creating manufacturing chains. And therefore, essentially the manufacturing bus that we seem to have missed for the last 20 years or maybe even more, I'm still saying that we need to pursue that, if not for the rest of the world, at least for ourselves. At least for the goods that we are consuming for ourselves, and we will consume a lot. 1.35 billion people will consume a lot. At least for the stuff that we need, let's be Atmanirbhar and start manufacturing for ourselves. This is not a closed economy. This is not. We're not saying let's ban imports and make do with low quality products in India. That's not the case at all. All we are saying is even high quality products competing with the rest of the world, we can pretty much make out here in India. So now a lot of people would also like to see make in India succeed. But we have to be realistic on this. The fact is that the whole, especially with this US-China trade war and this entire geopolitics, a lot of manufacturing is going into localization rather than globalization. People don't, globalization is a bad word at this point in time. So to expect that we will suddenly get supply chains for Walmart coming out of India instead of China could be a tall ask, right? It might not happen because China won't let go. And second is US might not want India in the first place. It might want to go back into its own country. So, but the point is, at least for our own consumption, there is no reason, make for India, there's no reason why that manufacturing cannot use our own people. And to your point, sir, people often ask, they're saying that we should have a demand stimulus right now, right? Because we have low capacity utilization, let's have a demand stimulus and that will be a nice virtuous cycle. The problem is as follows. Even if you give a demand stimulus and let's say COVID-19 is behind us, so we start to spend, and we saw that in 2010, 11, 12, 13, when there was a huge fiscal demand stimulus, when there was a lot of credit offtake which took place and people were spending, it ended up that we were not producing enough for ourselves. So we ended up importing stuff. We ended up importing energy, we ended up importing gold, electronics, plastics, fertilizers, chemicals, everything. And that's why our trade deficit completely blew up. And that's where, because there were supply constrictions in areas such as food, etc., our inflation also went up. So if you pump in money from a demand perspective, because we are not manufacturing enough for our own, because we're not producing enough output for our own requirements, we'll end up importing a lot. We'll end up pushing up inflation and weakening our currency. So, to those who argue for demand versus supply, I make the point that you made, or you summarized well for me, which is the missing link or the common factor to both demand and supply is jobs.
Yes.
The focus has to be on jobs. You're solving both demand as well as supply then. The moment, and the jobs can't be all Narega. It can't be dig holes and fill them up. That was good for Keynesian economics in the US. That is not good for us. We need output. So we need beyond Narega jobs, which actually create output, which can be consumed by us in Indians, if not the rest of the world. And that can form a nice virtuous cycle. So to me, the common link to supply and demand issues is the creation of jobs. We can create it. It will be extremely tough. I make no mistake about it. All the stuff I mentioned, cleaning up banks, cleaning up power sector, cleaning up real estate, land laws, labor laws, getting supply chains from China. This is easier said than done. I mean, it's easy for me to sit in my nice room here and talk about these things. It's going to be a multi-decadal effort, no questions asked. But I'm saying we don't have a choice. We have to start right now towards doing that.
Thank you. Thank you so much, Professor. I think you're putting it so very well, as to what is happening and what do we do. So now we get into that area of questions from our participants, and so since it is coming from the participants, it can go a little bit off from what we have been discussing. So let's take the first question from Mr. Rajan Jain. He asks two questions. One is on the he talks about generous dividend, excess of 1 trillion rupees. He says, what can RBI do so that they can give a high dividend to government? That's question number one. And question number two, he says, when will India become part of global bond index, and how much inflow will happen due to that? So two questions for you, sir.
Okay. Great questions both. Let me start with the first. I think the broader question beyond dividend from RBI balance sheet to government is, how do we finance the fiscal deficit? Okay. So there's going to be a large fiscal deficit, no questions asked. By the way, my own estimate is pretty pessimistic. I think between center and state, we could end up with a true fiscal deficit of over 14% of GDP. Okay. This will be a record high. And the reason for that is not because the government is spending a lot. I'm not assuming that. The fact is our tax collections are going to collapse compared to what the budgets were. The budget numbers were ridiculously high. So, you're expecting 25% growth on last year's actual tax collections this year, which is obviously not going to happen. You'll be lucky if you get away with minus 5% tax growth. So a big chunk is going to be simply the fact that tax collections are much lower. There's also 1 or 2% of extra spending that you'll have to do, which is inevitable. The government is trying to raise some money by hiking petrol prices, by cutting down on costs, not giving DA increases to government employees, etc. But I think your net expenditure will still be much higher. And of course, because your GDP is not growing, your denominator will be pretty low. And therefore, in percentage terms, the fiscal deficit will look high. Now, the question is, how do you finance it? Now, I have no doubt that the RBI will have to monetize a bit of that, a big chunk of that. Okay, it's not just a bit. By the way, we have a history for this. Okay, even in FY 19, which was 2 years ago, April 2018 to March 2019, if you remember, RBI actually bought 3 lakh crores worth of bonds in the secondary market through open market operations. It also transferred the last year, in fact, 1.76 lakh crores of one-time dividend to the government, which obviously went as income. So all that is monetization, right? We'll have no choice but to monetize this time as well. Now, to me, there is no difference how you monetize, whether you pass on a dividend transfer, whether you directly buy bonds in the primary market, whether you buy from the open market operations. The net impact in terms of financing the government and the net impact in terms of infusing money into the system, which means your deposits and your currency in circulation goes up, what's called the M3 actually goes up, the impact is the same. So, while we quibble about whether we should do direct purchases or, one-time dividend transfer, or you can, whatever makes you happy, do it. If you think dividend transfer is something which makes you feel happier, please do it. But it's the same impact as RBI buying bonds in the market. There is no difference at all. Now, off the lot, buying bonds in the market seems to be okay as far as rating agencies are concerned and as far as the external sectors are concerned. Now, I don't give a damn for rating agencies, but if it makes them happy, do it to them. Don't do primary purchases. I mean, because Indonesia did primary purchases and they were immediately promptly downgraded by S&P. So don't do it. Do open market operations. So I think financing the government deficit is not a problem. RBI should and will print money effectively by basically buying bonds or transferring dividend or whatever it is. How it is done is immaterial. It will get done. The problem will be that right now, because there is no demand, there is no velocity of money, as we call it. The normal problem with printing and spending is you risk inflation and you risk a currency crisis. Today, in the absence of any demand whatsoever, you're not risking at least demand-led inflation. You could have supply-led inflation because there's no logistics and all that, but there's no demand-led inflation. Similarly, currency on the contrary, we've got record level of reserves right now, $500 billion plus of reserves. Actually, money is coming in, given the fact that FDI is happening, Reliance Jio is selling its stake, and the current account deficit has become a surplus now for this quarter at least. So neither of them is a problem for the near term, but in the long term, there will be a cost to pay. With all this printing happening, with all this financing happening, there will be a cost to pay. The only way, according to me, to ensure this doesn't blow on our face in 2 years, 3 years' time, is to create jobs and output. Once you create jobs and output, taxes will go up, and therefore India's fiscal deficit will come under control. The only time when we reduced our fiscal deficit in the beginning of 2000, if you remember, 2008, was because our GDP was growing up. And because of that, tax collections are going up. We can never cut down our expenditure. We can only increase our revenue collections. So that is the first part. The second, on the index inclusion, look, it will take time. Now, I know even yesterday there was a news item that JP Morgan index, we might get an inclusion, etc. My own experience from dealing with index administrators, etc., is that China took many years. And after the announcement came, it took them 3 years to do it in stages because they will never open it up one day and start to do it. Now, if I remember correctly, there is a couple of large indices. I think it's called the Barclays Global Index or something, which are really large, which is where you want to get that inclusion. JP Morgan Emerging Market Index, the AUM is quite small. That tracks, it's relatively small. It's not very small, but it's relatively small. You might get $5-10 billion of money coming because of that. The larger indices, which is where China has got inclusion into, it used to be called the City Index. I forget what it's called now. And there's another one, which is the Bloomberg Barclays Index. I know what it's called now. There you have AUM of up to $2 trillion, which are tracking those particular indices. If you get inclusion into those indices, then the amount can be quite large. If I remember the number for China, I think they're getting a 10% weightage, and therefore the prospect of $200 billion of inflows over multiple years. So let's put it this way. I think eventually it will happen. Of course, the fact that we are now on minimum investment grade rating and the fact that Moody's has us on negative watch doesn't help. But I think all that will get sorted out. Eventually it will happen, and we will start to get in, therefore, a lot of passive investment flows. It will be good for the economy. But again, I would spend less time on worrying about how to raise the money and how to finance our fiscal deficit. All these will happen. These are all Excel spreadsheet solutions. These will all happen. The bigger problem and the bigger question to address is how do we get growth? How do we get jobs? That is a real economy problem which cannot be solved on an Excel spreadsheet. Everything else can be solved. So to me, that is the real. We spend far too much time worrying about these financial sector solutions and looking for brainwaves there. If we can solve the real sector, everything else will get sorted out.
Yeah. Thank you, sir. Mr. Rajan Jain, excellent question. 2 excellent questions. And I think, I hope you got the answers from Professor. Thank you, Professor. Professor, we also take a direct question. That means the participant will talk to you directly. So we have one question coming from Harish Prabhu, who is a very experienced banker. Harish, could you unmute yourself and ask the question?
Yeah. Thank you, Professor. See, the demand contraction is, as a result of, despite the fact that the Indian economy has grown post-globalization, the haves have a lot of money to spare, but they don't need and they can't drive the demand growth, right? And the have-nots want goods, but they don't have the money. So there's a classical problem that the demand contraction has, manifested itself in such a situation. My question is that, this will take a long time to sort of, actually play out, right, to demand growth. So do you see a permanent shift in the composition of our economy in terms of manufacturing, agriculture, and services? A complete shift? And if so, is it beneficial? The second question is, on the manufacturing opportunity, both for make in India or make for India, do we have even the building blocks of, in place? Because, we've been decimated. If you go to see any industrial estate all over the country, there's nothing there. So these are my two questions.
Both great questions, and in fact, they're worth a discussion by themselves with some better experts than me. I'm going to rely heavily on the work of other experts, and I'll quote them as well. So on your first question, Harish, on the haves and the have-nots, I think you put it extremely well. In fact, people like Dr. Ratin Roy, and if I remember, even Niranjan Rajadhyaksha, others, lots of people have written about this. The fact that we don't have a manufacturing base, or we don't create output for the entire population. We only create an output for about 150 million consumers, which is the top creme de la creme. That our entire economy is geared towards them rather than for the larger set of people, which is a shame. If you want us to grow, you have to grow the entire base. So you're absolutely right. And by the way, it's not a phenomenon only for India. This divergence between the haves and the have-nots, as you know, the discrepancies between the poor and the rich has just widened dramatically in every part of the world. Look at the US. I mean, the statistics there are pretty shocking as well. So it is definitely a problem, and it goes back to the solution goes back to what we were discussing earlier, which is about creating jobs. The fact that I think we missed out on this manufacturing boom is costing us heavily. It didn't allow that 44%, which is there in agriculture even now, to transition to something more productive. That productivity, obviously, in the agriculture sector is very, very limited. I mean, if you're producing 15% of your GDP, how much more can you 15 can become 16, but if you're using 44% of your population, obviously the productivity is going to be very, very low. So to me, creating those jobs for those 44 million and why do I keep saying 44 million? It's 44 crores, right? So 44% of your of the workforce. Creating jobs for them is what is going to be very, very key. That creation of jobs goes back to your second question, which is how the hell do we even think about getting a manufacturing base for make for India or make in India, given that we've fallen back so behind on competition. You're absolutely right. There is no comparison. And when I talk about get supply chains from China, if you go to the industrial towns or industrial SEZs of China, there is no comparison, India and China. There simply isn't. We'll have to start from scratch pretty much. Now, this is where I like the work of people like Ajit Ranade. Rather than go for boil the ocean, land laws, labor law changes across the country, what they suggest is the following. And I believe the government is working on things like this. So essentially look at land which is already available with the government, right? Either in railways, either in port trust, either in defense. So any government entity which already has a large chunk of land available, make that open up, available to anybody who wants to invest, either global players or domestic players. Make the labor laws in those specific areas, much easier, and then try and create a whole ecosystem. Now, I forget the name of the province in China which does a lot of the ready-made garment manufacturing. I've heard this from Ajit Ranade. They have this zip to Zara concept, right? So that same province or that same area which creates garments out there has pretty much everything out there, all manufacturing of the raw materials, all the way up to the design of a Zara output is done in the same ecosystem, right? And from there, you have a deep sea port, which takes the goods out to all over the world, which is why even today, ready-made garments, China is a huge, huge player, whereas our ready-made garments exports have been coming down over time. We have something in Tirupur, we have something in Ludhiana, we have something in Surat. It's all over the place, and it's all very, very small players, very bit players. We don't have the scale to be able to compete with any of that. So essentially try and create a whole ecosystem where you bring in scale, where you bring in easy laws, you give tax holidays, you give connectivity from the hinterland to the port for evacuation of products. It will require a lot of investment, a lot of work, which is why I said this is easy to say, very, very difficult to do. Now, the good news is pretty much all these things, whether it is banking reform, whether it is power sector reform, whether it is manufacturing and make for India or make in India kind of reform, you have so many committees of the past which have already told you what needs to be done. You just have to dust them off, change the date from the old date to the current date, and start implementing them. So I'll give you a recent one, right, for banking reform, PJ Nayak committee reforms, May 2014. Excellent set of recommendations. And by the way, it's not only about privatization of nationalized banks, which is a very controversial topic by itself. It's about giving autonomy to banks. So plenty of reports exist which tell you what needs to be done. Dust them off and start implementing them. Maybe make a few changes here and there to suit your particular requirements. So the point being that yes, it's very, very difficult. But the answer to both your questions, I think, is the same. We'll have to create jobs for those people who are less skilled right now, and make sure, therefore, that they can graduate from being the bottom of the pyramid to somewhere in the middle of the pyramid slowly. It'll take time. It won't happen overnight. One quick point, which I just want to emphasize. One thing I'm hoping will ensue from this entire COVID-19 mess, which obviously has delivered a body blow to us. I'm hoping that our investments into education, into healthcare, and into nutrition go up dramatically. For a country which keeps saying that our demographics and our young population is our strength, we've put such minimal numbers into these particular 3 areas that it's shameful, right? Hopefully, if there is one lesson we draw out, it is to invest more in this. The reality is, how do we create jobs for all our young people coming out every day? We have no idea. Because, in this day of automation, machine learning, artificial intelligence, we know that it's going to be very, very tough. But if we can give them these 3 things, education, which includes skilling, by the way, nutrition and healthcare, at least we give them the best chance in hell of figuring out a way for themselves. Just as our generation figured out a way through WTO and GATT and all of that, and still came out well. There's no reason why our kids will not figure a way out, as long as you give them the resources to do so, which is, these 3 basic resources.
Thank you very much.
Thank you.
Yeah, thanks, Prabhu, and thanks, Professor. Excellent. We have another question coming from Mr. Tripathi. Mr. Tripathi is a senior editor of ETV Global. Mr. Tripathi, please unmute yourself.
Yes, Professor Narayan. Good afternoon.
Yeah.
I just wanted to ask you 2 back-to-back questions. First, you said that we need to have liberal, flexible labor laws.
Yeah.
Some years back, there was a study by ILO that concluded that liberal labor laws have never resulted in bringing foreign direct investment. So is there any study that you can cite to support your argument that flexible labor laws will help us to bring more investment? Second thing, what is your reaction to this view by some economists that as long this time the problem in the economy has not come from within the economy. It has come from the inability of medical science to tackle coronavirus. And as long as medical science doesn't have any answer to this virus, economy cannot be revived, jobs cannot be created. How do you respond to these 2 things?
No, great questions, Mr. Tripathi, and they're both worth thinking about. So on this labor laws, you're right. Flexible labor laws, frankly, is a misnomer, and I should stop using that word flexible as well. It is easier to comply with labor laws. Don't change we obviously have to protect the laborers. I think what the 3 states have done right now of actually cancelling labor laws, to me, makes very little sense. You have to make it easier to comply with labor laws. So on this, Manish Sabharwal and Team Lease, they have on their website, they list out all the compliances that any manufacturing company have to actually deal with on a regular basis. I think if I remember correctly, and do check the Team Lease website, they list something like 5,000 laws that you have to comply with for any manufacturing company which is employing more than 100 people or something. Okay, the number of inspectors you have to comply and to deal with is again some ridiculously high number. If I remember correctly, some 200 odd inspectors if you have more than 100 people. Now, anybody trying to deal with so many, I hate to use the word, but so many babus and bureaucrats who can come in, inspect you, and make your life miserable. It's terrible. This is about, ease of doing investments is all about that. Make it easy for me. Give me simple principles to adhere to, which is ensure the safety of the workers, ensure they're not overtaxed, ensure they're paid fairly. Make it broad, easy principles to adhere to. Don't have some babu actually coming here and measuring every single thing and then maybe asking for something on the side, for 200 different people. That ease of doing business is what is being asked for, right? Now, so here is a way in which you can do that. And by the way, the reason why I push for labor laws even now is because I've spoken to enough number of micro, small, and medium enterprises, including some people who come to my own institute and study there under family management, family managed business program, etc. So there was this conversation I was having with a SME just a couple of days back, who last year closed his textile factory, ready-made garment factory in Tirupur and opened in Dhaka. Okay, he was a South Indian Tamilian like me. He can't speak a word of Bengali. He's opened in Dhaka. I've worked in Dhaka. Dhaka is not necessarily the most pleasant place for an Indian to work in. He says that in terms of actual compliance and in terms of flexibility to employ women workforce, have 3 shifts of women workforce in a flexible way, in the sense that because ready-made garment demand tends to be seasonal, during Halloween to Christmas is when a big amount of exports actually go through. You need to be able to hire more people during that period and then have it on a contract basis for 3 months and then move on, right? And then run 3 shifts of maybe women workers during that period. According to him, doing that in Tirupur was next to impossible. Doing that in Dhaka, he says no problem at all. And this is, by the way, Dhaka is not the epitome of good governance. It's after all this Indian subcontinent, right? So the point being that in terms of making it easy to comply and being reasonable and being investor friendly, being investment and employment friendly is I guess the key part here. It's not about making labor laws easy that I can start exploiting workers. That's not the question at all. And by the way, he also reports that the people who get employed only for a part of the year are also very happy, because once that period is over, they go on to other jobs. So, everybody's happy, more employment is created, as well as, investments happen. So that's one part on the labor laws flexibility. I should not use the word flexibility. Probably I have to find a better phrase for it. The second question was what, sir, about external point, about the medical point, right? Absolutely true. Absolutely true. So I have no doubt whoever is saying this is absolutely right. Personally, I have an aged mother who stays with me. I stay with her at my home. There's no way I'm venturing out of my home and doing things until I am sure that the chance of me infecting my mother is very, very low. That's a reality. So my propensity to spend whatever little I can is also going to be, very, very restricted until such time that, the virus is not solved, either a cure or a vaccine or whatever it is, or at least the fear goes away. Now, so having said that, our problems predate coronavirus. The fact that we were struggling with low growth, the fact that our banking and financial ecosystem was struggling with high NPAs, which we were refusing to recognize, the fact that our fiscal deficit, the extent and quality of our fiscal deficit was far worse than acknowledged, even before Corona, the fact that our power sector is doomed, the fact that our real estate is doomed, is all pre-COVID. I mean, how much will you blame COVID for everything, right? Secondly, COVID will go behind us. Just as, the Spanish flu 100 years ago became history, it will go behind us. We will come out of it, hopefully in a year's time, maybe hopefully even earlier than that, we'll come out of it. Okay. There is so much work happening on a vaccine right now. I'm hoping and praying we get some good news really fast, which is reliable and people can move on. The point is, even after that, if we continue with what we were continuing in the past, we are just pushing. See, we have a fantastic economic future. Our potential is tremendous. There's no doubt in my mind. But the more we delay taking on these harsh steps, the more we're going to make it worse or difficult for us to achieve our immense economic potential. So the fact that you still have to clean up banks and NBFCs, the fact that you have to solve this real estate mess, the fact that you have to solve this power mess, the fact that we have to make it easy for people like on this call to create jobs and to employ people and to manufacture and create output. So that has to be resolved. And we have to remember, it's not just the last 5 years, last 20 years, you struggled on job creation. So to me, yes, no questions asked. It is a necessary condition for economy to restart, the fact that we have to solve the medical problem, but it's not a sufficient condition. After the medical problem is solved, we will still need to do a lot of hard work. I would love it if we can acknowledge this, that it's like, all the stuff I mentioned to you, the true set of our NPAs, the true nature of our fiscal deficit, the reality about our employment. It's like getting a harsh medical report. Okay. Now we can say medical report is wrong and ignore it and we go on with our own lifestyle. Okay. But that is a terrible thing to do. Acknowledge the medical report. Acknowledge the fact that this is curable. Isme koi problem nahi hai. There is, as I said, no problem is not curable. Acknowledge that this can be cured. It will take a tough amount of work to be done. You have to take a lot of bitter medicine. A lot of people will be unhappy, but there is no other choice. Once you do that, that economy which is capable of running a marathon, I think is there. So all we need to do is acknowledge the medical report, do the treatment, do the rehabilitation, and believe you me, we will be ready and fit to run a marathon. Our potential is obviously extremely. As I said, I've worked in 12 countries, including Vietnam, by the way. Worked meaning I've gone there and I've helped run businesses out there. I don't see a single country which has the fire in the belly and the potential that India has. And obviously, you're hearing it from a biased Indian, but nevertheless, having seen many of these countries, I still think we have tremendous potential. So we will get there, but a lot of, acknowledgement of the truth and hard steps towards the second generation reforms have to happen. I'm hoping this is the great time like 1991 to actually conduct second generation reforms.
Thank you. Thank you, Mr. Tripathi, and thank you, Professor. Lovely answers to his queries. So we are already 7 minutes past our regular time. Do you have another 2 or 3 minutes?
I have time. Apologies. I love the sound of my voice. So once I start talking, I refuse to stop talking. So,
yeah. So just one brief, one question, which is also for me, and the same question is asked by Mr. Aslam Chechkar. He says, do you foresee inflation spiking significantly in the next few months?
It's a great question, Aslam, and thanks for asking that. I think the risk is quite large. I would not disregard that risk at all. So, okay, so the immediate inflation will probably come from the supply side. Okay, the fact that, logistics has been hurt pretty badly. Interstate movement of goods was hurt for a long time. So you would have a weird situation where WPI has gone negative, wholesale price index has gone negative. That's because at the wholesale markets, people are dumping stuff and nobody's evacuating, even the agricultural produce for that matter. But CPI could still remain pretty high because the logistics is making the problem. So it's not a demand-led inflation, it's a supply-led inflation. And it's not just food, by the way. Even items such as cement, etc., showed some supply-led inflation in the first month, in April itself. Okay, so the immediate inflation I'm not so bothered about because it's largely supply-led, it's not demand-led. But here are a couple of things which are worrying me. One is obviously the hike in petrol prices. Okay, the government is doing a smart thing. You can argue smart or otherwise, but it's actually increased excise duties on oil pretty strongly. And right now, for the last 10 days, we've seen a record increase in petrol prices. I think it's a big blow to the economy, which is just recovering right now to pay such high prices. But that's okay. That's one part. Okay. Second part is on labor. Okay, and here is my paradox. You would think an economy which is shrinking and really coming down will see labor prices coming down, as in wages coming down. And you're seeing that, right? People are taking, lots of companies have announced pay cuts, have announced 30-40% reduction to the senior people and so on and so forth. Funnily, on the ground, research shows that labor costs are going up. And the reason for that is twofold. One is, of course, a lot of migrant labor has left the industrialized town, right? So therefore, in places like Punjab, Maharashtra, Gujarat, Tamil Nadu, etc., where there is a restarting of activity happening, there is no labor available. So people are actually willing to pay higher costs to get the labor back, right? So that's one part. Second part, the migrant labor which has gone back to the cities, to the villages. Remember, I mentioned that Narega is working now. Narega will offer you 100 days of employment at pretty high rates, right? So it's quite possible that that labor stays on in the villages for a few months, lives off Narega, is happy and struggles to come back to the cities. So in a very paradoxical, funny situation, you could actually see labor costs going up. So that's the second worry I have. Third worry I have, I mentioned to you, center plus state fiscal deficit could go to 14% of GDP. And a big chunk of that would be monetized by the RBI, either by buying bonds or by transferring dividend, whatever it is. Some conventional, unconventional methods, as Governor Das says, he'll use everything. Okay. Effectively, this is printing and spending. Okay. Now, printing and spending, not a problem right now because there's no velocity of money. Money is not moving around. So even if you have lots of money, if it's not moving, no inflation, no demanded inflation. Eventually, though, if we, let's say years' time, if activity starts again, there is so much money sloshing around that we could risk what we saw in 2011, 12, 13, which is both domestic inflation, because too much money chasing, let's say, too few proteins, too few dal, too few eggs and milk, etc., and higher imports because we're not producing enough for ourselves. So we start importing goods from China more, right? That could be a problem. So just as we saw no issues in 2009 in blowing up the fiscal deficit, but 2011, 12, 13 saw inflation going up and the currency tanking, we cannot say that will not happen in a year's time or 2 years' time. So on all these counts, I would still be worried about inflation, even though right now there is no sign of any inflation.
Thank you, Professor. I think we held you back by almost 11, 12 minutes, but we respect your time, sir. So we have to wind up this this session. Sorry, some of the participants still want to ask questions, but we'll keep it for the next time. Hopefully, we will. Professor will come again. Sir, it was wonderful talking to you. There's so much we covered, and I think, like you said, we need to run a marathon. That's very clear. Like we have to run the marathon. And I think one elixir for all our problems could be jobs, jobs, jobs. I think if we do that, I think most of our problems around us will get resolved. And thank you for such an insightful discussion. Ladies and gentlemen, I hope you enjoyed listening to Professor as much as I enjoyed discussing with him. And thank you very much, Professor Narayan. And hope to see you some other time. And we'd love to have you again. It's been great talking to you. Thank you so much.
Pleasure is all mine, sir. Thank you for having me, and all the very best. And I wish you well. Thank you.
Thank you. Thank you.